Live from New York City this morning. Good morning, good morning. The losses continue. The S&P down about 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. Pivot. What pivot? Fed Chair Jay Powell says there's more to come. Governor Bailey is hiking into recession. And President Lagarde is going full hawk.
Wavering. We have more ground to cover. We have longer to go. We're in for the long game.
Joining us now is Invesco's Rob Waldner, Jim Bianco of Bianco Research. Jim, President Lagarde, we're not pivoting, we're not wavering, we have more ground to cover, we have longer to go. We're in it for the long game. What do you make of the central bank communication this week, Jim?
It was hawkish, there's no doubt about it, that their focus is on inflation. And I think if you were to, define that a little bit further, yes, inflation has peaked. Yes, we all know it's coming down. And it's not really what's important. What's important is it going to 2% or is it going to 4%? And it seems like central banks are going to stay with their foot on the brake until they get solid evidence that it's going to go to 2%. And that's not going to happen anytime soon. So the full hawk, as you pointed out, is going to stay, and it's not going to go away, at least in the near term.
Rob, what's your take on this?
I thought it was extraordinary, John. I mean, we know growth is slowing. We've been getting good news on inflation. The yield curves in the U.S. and Europe are very inverted, as inverted as they get, essentially, telling us that the Fed has max credibility, ECB has a ton of credibility, and they're going to push it when they're ahead. I don't really get why they felt like they needed to be quite so hawkish.
So, Rob, it raises the question, why did President Lagarde seem to gain more traction with this market yesterday and this morning, by the way, than Chairman Powell did on Wednesday?
Well, probably because the Fed is further along than the ECB. She was also very, very clear. I mean, we're not pivoting. We're not pivoting. So I think those are probably some of the driving factors there. And I think that the U.S. market has had a while to contemplate where the Fed's been going. We've got much better inflation data in the U.S. than we have gotten in Europe recently. And so the U.S. market just doesn't believe that the Fed is going to be able to deliver.
What's going on with that, Jim? President Lagarde shakes things up in a massive way. And Chairman Powell, there's so much doubt, skepticism. Does one have more credibility than the other when it comes to projections?
I don't know if one has more credibility than the other one, but right now I agree with Rob. I think that, the Fed has been at this game of being aggressive and hiking rates a lot longer than, as I like to call her, Madame Lagarde has been. She's only now just catching up to it. And that's why I think that when she comes out and says we're not going to pivot, we're going to continue to stay the course, it has more weight. If the ECB had raised rates 400 basis points already like the Fed had, you might have gotten a different reaction out of the market. But the market is looking at a big catch-up now by the ECB to catch up with the Fed.
Well, a massive catch-up in this market as well. Yesterday on an Italian two-year, front end of the curve, two-year up by almost 40 basis points. Add some more weight into that yield this morning, up another 10 basis points on an Italian two-year to 3.15%. This is what Michael Harnett over at Bank of America has got to say on this, gents, and I'd love your view on it. He says central banks are tightening into a mid-23 hard landing. The Fed has delivered 400 basis points of hikes in 9 months. There's another 50 to 75 expected in the next 5 to 6 months. The ECB's gone 250 in just 6 months, and we're looking for another 125 in the next 9 months. He said quicker labour markets, the quicker they break, the quicker they enter this bear market. Jim, do you share that view?
I do share the view, especially the last part of the view, that it's about the labor market. And that if we were to get the labor markets to break, that will change not only Fed policy, but all central bank policy. But labor markets have not broken. There's very little evidence right now, other than maybe some tech firms have laid off a lot of people, and you could throw Goldman Sachs today into the hopper. But that's not going to be enough to move the needle. We still see strong payroll growth. We still see low initial claims. We still see a great number of people looking for jobs versus the unemployed, that Powell's favorite metric of 1.7 open jobs for every unemployed person. That's what the Fed's focused on, and they all sum that all up, and we still see wage growth at 5%. So, yeah, if any of that stuff changes, that'll change policy, but it's not. And that's why I think that the central banks just continue to plow ahead.
You mentioned Goldman. The stock's down by 1.7%. Goldman considering as many as 4,000 job cuts. That could be 8% of the workforce. Bloomberg reporting the top managers have already been asked to identify potential cost reduction targets. Shonali Basak racing into the studio for us. Shonali, what's the latest?
We heard just a week ago from David Solomon saying that pruning would probably be likely here at the bank. And now you're seeing what that number could look like. 8% of the bank's workforce. Remember, the headcount is really swollen here, John, in recent years. You've seen acquisitions, you've seen hiring, you've seen growth in new businesses. And remember, they're preparing now for a tougher time ahead. Take a look at that headcount rise just in the years since David Solomon took over since 2018. I will say what's interesting, this is coming after the highest returns on equity you've seen since 2007 last year. Remember, other parts of the bank outside of that consumer business, outside of that markets unit are very profitable. They've been minting money in trading. They've been minting money in investment banking, even in a hard year. And the question then becomes for Goldman, can you take from Peter to pay Paul? They have to spread the love across all the businesses as they look at their profitability targets. Remember, Goldman Sachs next year in February is going to have an investor update, and this is preparing ahead of that. These cuts are not ones we are seeing yet, but again, we will know in the coming weeks and months where these cuts come from, how deep they go. Will they go deeper than this initial 8% that is being considered now, and where they come from? I love this chart really quickly here too, John. If you take a look, the salary and benefits as a percent of sales here, Goldman has tended, it's that blue line over there, has tended to be very, 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 very efficient relative to peers. And so when you see them lead the market here in the job cut story, the reality here is it could be a harbinger of things to come. It tends to be a sign for other banks to show that maybe they have wiggle room here on the expense line.
Shonali, thank you. Wonderful work, as always, and great reporting from the team here at Bloomberg. We'll catch up with Sri Natarajan at about 24 minutes on the same story to get another update for you. Jim Bianco, which one is it? There's a word that I get scared of. It's idiosyncratic. Things happen in tech. I'm told it's idiosyncratic. They start to happen in banking and financials. I'm told it's idiosyncratic. Which one is it, Jim? Is there something going on here in an industry that's specific to these names, or something happening in the broader economy?
Well, the signs are not quite there when you talk about the labor market in the broader economy. The signs are only in tech with the layoffs and in the interest rate sensitive markets of like real estate. That's where you're starting to see a lot of the weakness. But in the rest of the broad economy, you're not seeing it yet. And the reason I bring that up is, again, I, like a lot of people, do suspect that you will see a slowdown going into 2023. But you need to see that. The chairman has been very clear. Show me the slowdown first, and then I'll consider changing policy. And the longer we go without seeing that, and as long as it stays idiosyncratic, I don't think you're going to see the Fed pivot off of any of this kind of move or even slow down with its belief that they've got to go above 5% on the terminal rate.
Well, let's recap the data this week. We can look at industrial production, Rob Waldner. We can go over what's happened with retail sales, and then we can look at jobless claims. Factory production declined for the first time since June. We had retail sales yesterday dropping the most in 11 months. And then we had jobless claims come in just above 200K. Begs the question, really, doesn't it, Rob? What should I be focused on? Because the labour market, just looking at the headline data, says things are OK. Then there's cracks elsewhere.
Absolutely. So we seem to have gotten to this point where we're hyper-focused on the labour market. The Fed has told us that's what they're looking at. But I'm not sure that really makes that as much sense as looking at the overall economy. We're assuming here that the Phillips curve is suddenly going to start to work, and that the whole basis of the idea that to get inflation under control, you have to raise the unemployment rate is really around the Phillips curve, and that hasn't worked for a couple of decades here. So I think we should be paying more attention to the economy itself, Jonathan, and not the labor market data per se, to understand how inflation is going to evolve.
Well, let's talk about the economy, and let's talk about another consensus view for 2023. We've all heard the following words: short, shallow. This from the ECB in the statement yesterday. It said, according to the latest Eurosystem staff projections, a recession would be relatively short-lived and shallow. I caught up with Alessio De Longis yesterday of Invesco, and I asked him whether we should question that consensus view into 23. Take a listen to what he had to say.
the economy is a lot more resilient than we think it is. A mild, shallow recession is a hypothesis that is credible, but probably a little bit longer in duration. What if restrictive policy for a lot longer means simply growth below trend for a lot longer, or negative growth for a lot longer, but without that much volatility? That's, to me, an open question.
Let's explore that question right now. Jim Bianco, we're essentially assessing depth and duration. Depth, the shallow piece of this, I'm told repeatedly, resilient economy doesn't have the excess it's built up in previous recessions, doesn't exist, it's going to be shallow. Duration is the point I want to sit on just for a moment with you, Jim. If these central banks are determined to stay high for longer and take out demand in this economy, shouldn't we be questioning that half of that theme for 23, which is short, shallow? Where does the short piece of it come from?
I agree. We should be questioning it. And as far as the short piece, Jonathan, let's back up. Does anybody remember that the first and second quarter this year were negative GDP, and the third quarter growth barely recovered with what you saw in the decline in the first and second quarter? So if the economy turns down in 23, you could argue it's well over a year since the economy has peaked. That's not short at all. As far as the shallow part goes, if you look at history, it's very hard to get a soft landing. A soft landing is what you usually call the economy right before it crashes. And because when it starts down, it usually continues to go lower. You know, one good example is what's called the Somme rule, named after Claudius Somme, former Fed economist, that when the unemployment rate goes up 0.5%, and that usually happens in a recession, it usually goes up another 2% after that, or maybe even 2.5% after that. So I know that people like to think that the unemployment rate is going to go to 4.5. Well, if it goes to 4.5, it's more likely to go to 6 than it is to peak at 4.5. And that really calls into the question the idea that it would be shallow.
Let's build on that, Rob. We're assessing the potential duration and depth of a recession in our future. Maybe it's just around the corner, perhaps it's further out. Rob, do you push back against any of it?
So I think we need to break this down. And the length is going to be determined by the Fed, the depth by imbalances in the economy. So let's break that down. The central banks are getting very, very hawkish. So I think that we're going to have a big headwind to growth here for quite a while, because they're telling us they're not going to cut rates. So if that's the case, this could be a long period of subpar growth. In terms of depth, I think that's about imbalances in the economy. And we just don't see them, Jonathan. We don't see where there's a buildup of leverage in the economy, in the real economy, that could impact the financial system or that needs to be worked through out of the households. In general, you know, without those big imbalances, we don't think the depth, we get a deep period. So it would be, you know, a longer period than we might expect of a subpar growth, but not a deep, sharp recession.
So does that leave you bullish or bearish on fixed income and Treasury specifically? I'll share a quote with you from SocGen Sabahat Rajappa. I'd love your response to it. Powell is stuck to his script of higher for longer after delivering a 50 basis point hike. She went on to say a hawkish shift in the dot plot failed to nudge yields higher, but ultimately they expect a modest rise in yields in the first quarter as central banks deliver more hikes. Now let's pick the 10-year. Let's pick one maturity across the curve and go with the 10-year, Rob. Your theme for next year, is it bullish or bearish, this bond market?
So my theme for next year is very bullish, this bond market, because we re-rated the public fixed income markets, treasuries, investment grade, much higher. You can get good income now in the fixed income market. So for all of 2023, unmitigatedly bullish for fixed income. In the shorter term, though, you know, we have now the most inverted curve that we generally tend to get between 2s, 10s. And so if you want to talk about the 10-year note, as the Fed continues to ratchet up yields here at the short end, they're going to really put a floor on where the 10-year note can go. So we don't expect to see a big rally from here. Indeed, we think we're kind of in a range of yields may go up, giving us a better entry opportunity in the first part of next year, but unmitigatedly bullish for 2023.
Jim, final word here.
Yeah, I agree with a lot of what Rob said, that you're going to see probably a parallel shift in the yield curve. If the Fed's going to keep raising rates, a quick statistic for you, the 2-year note yield has always peaked above the terminal rate. If the terminal rate's going to 5 to 5.25, then the 2-year note will probably peak above 5.25. and parallel shifting, that means it's going to drag the 10-year higher. I agree with Rob. The yield curve is probably not going to get much more inverted than it is now. Most of the yield curve flattening to inversion is behind us. Its steepening might be a way off, but I don't think you're going to see much more flattening, so everything kind of shifts higher with the Fed.
Jim, can I just pick up on one point? Are you saying that 480 earlier this year was the high and the Fed won't get there, or are you saying the Fed's going further and the 2-year wasn't the high?
No, I think the Fed's going to 5 to 5.25 in the terminal rate, and the 2-year note will have to go to at least 5.25 because it always peaks above the terminal rate.
Jim Bianco of Bianco Research is going to stick with us alongside Rob Waldner. Right now, equities are lower by a little more than 1% on the S&P 500. Coming up, the Fed speak returns.
My colleagues expect the Fed funds rate to get to, say, 5 to 5.5% next year. I think that gets us into that hopefully sufficiently restrictive stance of policy.
That conversation up next. Eastern Time. Back with us for a final word, Rob Waldner, Jim Bianco. Jim, can we start there? Mike's talking about it, this tension between what the market's looking for, rate cuts, and what the Fed is looking for next year, anything but.
Yeah, in fact, the divergence between the market and the Fed is one of the largest we've ever seen. You know, the market's got the terminal rate peaking under 5% and rate cuts starting in the second half of the year. The Fed's got it peaking above 5 and holding there all year. So next year, 23, is going to be a year where somebody's got to give. Does the Fed give to the market, or does the market have to give to the Fed? 2022, it's always the market always talking about pause, pivot, step downs. Most of the time the market was wrong and they had to come to the Fed. If they have to come to the Fed again in 23 by readjusting their sights higher on interest rates and the terminal rate and when the Fed's going to start to finally cut, then we could be in for some rough sledding, because I think a lot of the market is hoping that we're going to see some kind of a pivot in 2023, and the Fed is not projecting that right now.
Hey, Jim, your best guess then, you look at that spread right now, it's the market coming up to the Fed and not the Fed coming down to the market?
Yeah, I think so. I think that the market's going to have to realize that the funds rate they think is going to be around under 4.5 by the end of the year. It's probably going to be closer to 5 by the time we get to 1 year from today.
Rob, what about you?
I think the Fed is going to have to come to the market, especially the second half of next year. I mean, if we run several quarters of below trend growth and break evens, continue to come down here, and so the Fed, the Fed, I think, will be in a position where they're looking at inflation really coming towards their target, growth very, very weak. The pressure on them will all be about supporting growth, The inflation, panic will be over. And I think they'll probably be cutting by the second half of next year. So still have to come to the market.
So it's interesting you two both disagree on this, but agree on buying bonds. Jim, can you help me work that out?
Well, a lot of that has to do with what Rob said, is that you've got a yield now. So when you started the year and rates went up, you were getting no yield. You were just getting loss from the price. But right now, with a yield, that is a big cushion for bonds. And so while the first half of the year you could see yields go, or prices go down and yields go higher, you're getting paid to own them now, something we haven't seen in quite a long time.
Final question. Indulge me, even if you don't care. Pick one, France or Argentina. Rob Waldner.
France.
Jim.
Oh, the ghost of Saudi Arabia. I'm going to go with France, too.
There we go. Jim Bianco, Rob Waldner, to the both of you. Fantastic, as always. Appreciate it, gents, this morning and for the whole of this year. I really do. Thank you. Equity futures right now down a little more than 1 full percentage point on the S&P. Coming up the morning calls and later, weaker consumer confidence painting a gloomy picture potentially for 2023. That's the view of Julie Beale, of Kane Anderson Rudnick. Julie joins us around the opening bell. The opening bell, 7 minutes away.